Hi, we're going to be doing this video on recording purchase transactions for merchandisers, and I'm going to be using exercises 6-21 and 6-8 from our text. Now, we said that for merchandisers, our cycle begins when we purchase inventory that we can then later mark up and sell to our customers. So it's essential that we first purchase inventory in order to sell it. And that's what this exercise is all about. Let's read. During the month of June, ACE Incorporated purchased goods from 2 suppliers. The sequence of events was as follows. And we have a sequence of events, and then the requirement is to produce the journal entries to record those events. Let's begin with June 3rd. Purchased goods for $4,100 from Diamond Incorporated with terms 2% 10, net 30. The 2, remember, stands for the percent of discount. The 10 is the discount period. If ACE pays for the goods from Diamond, within 10 days they can take a 2% discount on the goods that they keep. If they do not pay within 10 days, they must pay the net amount, in other words, the purchase minus any return, within 30 days. Now, how do we know whether this is a cash or credit sale? We know it's a credit sale because we have credit terms here. There would be no reason to give us credit terms if it were a cash sale. So let's record this. Let's put our date, June 3rd, and what we're purchasing are goods that we plan to resell, which is called inventory, and we're paying later. So we'll also use the accounts payable account. Let's debit inventory because we debit assets to increase them. And we will credit the accounts payable account because that's the account that we use to keep track of purchases made on account or on credit, for which we'll pay later on. So both our assets and liabilities are increasing. On June 5th, ACE returned goods, or inventory, costing $1,100 to Diamond Incorporated for credit on account. Remember, we said that the return, or the allowance, is just the reverse of the purchase entry. So let's skip a line and then put the 5th there for June 5th, and we will debit the accounts payable and credit inventory. We will do the opposite. Debiting liabilities decreases them, and that's what we want to do when we return merchandise. We want to have that amount taken off of our bill. And then we'll credit inventory to reduce our inventory account because we've returned it. We no longer have it. Okay, now let's go to June 6th. On June 6th, ACE purchased more goods, this time from Club Corporation for $1,000 with terms 2% 10, net 30. So we'll do the same entry as on June 3rd. We will debit to increase the inventory asset account. And we know that that purchase is on credit or on account because we've been given credit and discount terms. So we will credit accounts payable to increase the liability account. We owe more because we've purchased and not paid. Okay, now on June 11th, ACE paid the balance owed to Diamond Incorporated. Let's find out how much we owe Diamond Incorporated. I'm going to make a little T account here, and we'll call this Accounts Payable Diamond. I'm going to have to abbreviate there. And I'm going to post into that account all the activity we have with our supplier Diamond. We credit their accounts payable $4,100 for the purchase we made on June 3rd, and then we debited the accounts payable for Diamond $1,100 for the return on June 5th. Therefore, the net amount that we owe Diamond is $3,000. That's the current balance in their account. We owe them $3,000. Now, if we are paying them within the credit terms, the discount terms here, within 10 days, we can take a 2% discount on the amount of goods that we kept, the 3,000. So let's see. They were purchased on June 3rd, and now we're paying them on June 11th. That's only 8 days later, and we're allowed 10 days in that discount period, so we can take a discount. So to calculate the discount, we would multiply 3,000 times 2%, and we would get $60 as the amount of the discount. What we'll do on the 11th is we will debit accounts payable for the full amount that we owe Diamond Corporation, for the full $3,000 balance, and that will wipe out our debt. Now, if we're going to take a discount and only pay $2,940, why would we debit accounts payable for the full amount? The reason is, if we debit accounts payable for anything less than the $3,000, it would look like we still owe Diamond money, and we don't. They told us we can pay less if we pay early. So we debit accounts payable for the full balance that is owed, the purchase less the discount, and then we credit the inventory account for the amount of the discount. We said that was 2% times the amount that we kept, $3,000. We're crediting inventory because the inventory costs us less, because we're paying less for it, because we're paying within the discount period. It's not that we have less inventory, it just costs us less because we're paying for it early. And the credit to cash, the amount of the check will be $3,000 less $60, or $2,940. Check to make sure the debits equal the credits. Debits are $3,000 and credits added together are $3,000. Our last journal entry is on June 22nd, and on that date we paid Club Corporation in full. Now let's see when the purchase was made. The purchase was made June 6th. We purchased goods from Club Corporation. The terms were 2% if you pay within 10 days. 10 days of June 6th, it would be June 16th, and we're paying later than that, 6 days later than that. So we do not qualify for a discount for this second purchase of goods here. To qualify for the discount, it would have to have been June 6th plus 10 days, or paid by June 16th. We're paying too late. So the full amount that's due has to be paid, and that amount is $1,000. We will debit accounts payable to reduce that for the amount that we owe, $1,000, and we will credit cash for $1,000. And our journal entries are done. Now they want us to calculate the cost of the inventory purchased. And you can go about this in two different ways. If you want, you can create an inventory T account for yourself and post transactions to it. I'm going to zoom out a bit so that you can see the journal entries and the T account that I've created. Remember, inventory is a current asset on our balance sheet. Assets are on the left side of the accounting equation, so we increase on the left, or the debit side. We decrease on the opposite side. Let's post our transactions to the inventory account. We have a debit on June 3rd for $4,100. That was a purchase. Then we have a credit on June 5th for $1,100. That's a credit for the return. Then we have a debit on June 6th for $1,000, another purchase. And then a credit to inventory on the 11th for taking a discount. And that's it. So if we add down our debits, we have $5,100. Our credits total 1,160. If we subtract, our balance is 3,940. You can also do this by just writing down, making a list of the transactions that involve inventory. For example, you could have written, I'm sorry, that's not January, it's June. June 3rd, there was a purchase of 4,100 that would have added to the inventory account. And then on June 5th, there was a return that would have subtracted from the inventory account. Then on the 6th, we had another purchase, which would have added to inventory. And then we had a discount, which reduced the value or cost of our inventory. And so that would also total $3,940. Notice that when we use a perpetual inventory system, any transactions involving inventory get put into the inventory account. We add to inventory for purchases. We subtract from inventory if there's a return or if there's a discount. And that's the end of our demonstration video. Please take a look at our next mini lecture dealing with sales transactions. Have a great day.